Let's welcome our first guest of MIDCAP Radar. It's an important guest because this is an important day. Joining me in the studios is Srinivasan, the Executive Director, Axis Bank. Thank you very much, Srini, for joining us.
Thanks, Lata. Many congratulations on your 15th birthday.
Thank you very much. Next year I'm going to be 16, so I'll expect celebrations on the 16th birthday as well. Okay, well, Srini, there's been a lot of news in the banking space. A bunch of you have cut deposit rates. Tell us which are the buckets you all have cut. Which of them are, are they major, like one-year deposit buckets which bring in a lot of money? Is it going to make a seminal difference to the cost of money?
I think as far as Axis is concerned, one is we have cut deposit rates. I think the deposit rate cuts have been sharper at the very short end. Say less than 90 days of the deposit rates cut have been extremely sharp, because that's some money which possibly we don't need right now. Even in the longer maturities, deposit rates have been cut. That's a function in terms of demand for money, but also specifically as far as Axis is concerned, we did the largest infra bond issue. We raised 5,700 crores of infra bonds, the largest ever infra bond issuance till date. So that happened last week, and that was a huge success, and that to some extent also obviated the need for long-term funds as far as we are concerned, and that also played a role in terms of reducing rates. So on the whole, rates have been reduced from 25 up to 75 basis points across tenors. Okay. If you look at the impact as far as cost of funds are concerned, I think the balance sheet is so large that these amounts ultimately will all add up, but these are still small amounts, and so for in terms of NIM impact and whatever, it should be marginal.
The 5,700 infra bond issue, ultimately in terms of CRR, SLR and PSL forbearance or whatever incentives, will add just about 2 or 3 basis points in terms of the cost.
It's more in that range.
But this is 25 to 75. In the long haul, is not this going to make a seminal difference? Say by end of FY15, will not the reduction of deposit rates be an important addition to margins?
See, the whole thing is that deposits mature over a period of time. As you're saying, it's not possibly 6 months. The entire deposit pool, which is possibly, if you assume 12 to 13 month maturity, in terms of average maturity across all types of deposits, that will reprice over the full year. So you will...
Okay, let me put it this way. Let's forget margins, because that will depend on the lending rates as well. If you only look at cost of money over a 12-month period, how much would you have saved?
That's basically what I'm saying. This 25 basis points will flow in over a period of 12 months.
Yes, but how much will it be? Is it a 1 percentage point fall in cost of funds?
No, it will be 25 basis points, right? Because you are repricing deposits, meaning which were possibly 25 to 50 basis points higher, which you accumulated over. It's not
but
like
there are also some 75. So is that your major bucket?
The whole
25?
thing is last year, when you had the FX crisis, that situation was different, where you were borrowing at very high rates, and the repricing was happening at much lower rates. So if you look at the last, if I'm assuming over the next 1 year, what am I repricing? If I'm looking at the previous, say, 6-9 months, what was I borrowing at? It is possibly 25-50 basis points higher. So that repricing is just 25-50 basis points higher.
Over a 12-month period.
Over a 12-month period. But the whole thing is not that. The whole thing is this a trend? And how much of this is going to continue? And over the next 3-6 months, it's not what you're repricing today, but is this repricing going to happen much sharply lower?
Why don't you answer that question? Because that would have been our next question anyway. If the governor is as good as his word and there is a cut in the first quarter, at some point, even if it is April, what are you seeing in terms of...
See, I would think starting next financial year, deposit rates could fall faster. The only reason I'm saying that is, as you approach the last quarter, credit growth has been slow this year. Q4 is typically very high in terms of overall credit growth. Bulk of it happens in the best part of it happens in Q4, and therefore demand for money in Q4 is higher than the previous 3 quarters, and therefore banks typically would not be lowering deposit rates sharply in that quarter, unless you have an event which causes tremendous amount of liquidity to come into the market, or a sharp reduction in rates from RBI. That we'll have to see how it comes. But again, you don't expect any sharp changes in rates. Hopefully there's something in Q4.
So the reduction comes in the first quarter of FY16.
Now, deposit rates that's when demand for money becomes lower, and therefore banks will be more amenable to cut deposit rates.
Okay, what is your sense on credit growth? Because Axis has generally been above industry estimates. What are you tracking in terms of credit growth at this point, and what are the trends that you're seeing?
See, credit growth, as you've seen the banking system itself, it's been fairly lackluster as far as this year is concerned. The hope is it picks up. But I think getting to levels which are close to RBI target levels is something which is going to be...
So what are you all currently tracking, and which are the sectors that you all are getting more response from, or you all are comfortable lending to?
So I think the credit growth, what you should expect, the system should be in the region of, say, 13 to 14% for the year. That is a view. And as far as Axis is concerned, as you're saying, we should be doing better than that as far as that. And in terms of financing, I don't think so you're seeing any single sector in which investments are going through. I think if you're looking at what can change, is primarily from a point of view of people who are able to access bond markets or money markets are doing that a lot more now than before, because the differential in terms of cost of funds for them, these markets offer them more value. And therefore, you are seeing only refinancing of existing loans, where corporates again are seeing how they can refinance it at lower rates, and incremental working capital demand. I think those are the ones which are driving credit growth. And if you look at what's going to happen right now, is I think ECBs to some extent, because of credit spreads for Indian corporates being much narrower now than before, you are seeing preference for ECBs also increase. And this is also causing slower rupee credit growth, which is what we are experiencing. So whether it's money markets, whether it's bond markets, whether it's ECBs, all these are and oil company demand in terms of need for rupee funds, all these are eating into...
No, the governor was making the point even in the interview to me that credit to industry has not fallen as much as credit offtake from banks appears to give the impression.
Rupee credit offtake.
Absolutely.
Rupee credit.
Yeah, but the more seminal question, and if you can give me a more pointed answer, when will you cut lending rates? When will the system cut lending rates?
I think the answer is clear, that as our cost of funds comes down, I think we will track that as far as the base rate is concerned. And we did that recently. We lowered our base rate from 10.25 to 10.15. And as we see that playing out on our cost of funds, we'll continue to sort of do that. And let's hope that we are able to lower cost of funds even more, and surely the transmission will happen.
Srini, what's the NPL situation? Has it already plateaued? I think I remember your Top Gun saying that, which includes yourself, of course, that NPLs have probably troughed out or whatever, peaked off, if you please. But with a falling interest rate syndrome in the system, do you think that for the system as a whole also it has peaked?
Yeah, I think what we've seen over the course of this year is addition to NPAs being possibly slower than what you've seen in the past, and that to some extent indicates that the pipeline over a period of time is going to fall off. And when we talked at the beginning of the year, we guided that saying that this year looks very similar to last year, and we should see a lot of the stressed assets play out through the course of this year, and that is broadly what is happening right now. So you should see this year possibly being as good or as bad as last year, and possibly FY16 being a bit better. Okay.
Based on your guidance for FY15, your total stressed asset formation was 6,500 crores for FY15. So that implies for the second half, you should do around an average of 1980 crores to be precise in Q3 as well as in Q4, which is higher than what you did in Q2. So do you think that will get worse, and where will it show, in slippages or higher restructuring?
So I think that number has both restructuring as well as NPS, as you're saying. And to that extent, we need to be a bit careful in terms of the composition, because if we are looking as far as this financial year is concerned, it is a slightly different financial year from others, because from FY16 there's no restructuring. So you could see, again, it's not that we would do it, but again, as a banking system, we need to see how exactly the system reacts as you get closer to the day of March 31st. So to that extent, I think there is some cushion there. There is some cushion in terms of how exactly when we set 6,500 crores of incremental additions to NPAs and restructured assets. I think what is more important is credit costs, because whether it comes from restructuring or whether it comes from NPAs, ultimately what hits the P&L is the credit cost. And there I think we have said around 75 basis points at the beginning of the year, and that's where we expect the year to close at.
What's the deal? Do you have any exposure to gas-based power companies or SEBs?
No SCV exposure. Gas is very, very small.
Okay. And do you see a fairly substantial gain for your bank because of the way bond prices have moved? Will not that shore up profit for you as well as for others?
So I think any bond dealer will tell you, I think when yields come down, it's a question of you are NPVing all the profits upfront. So when you get when you realize bond gains, because unless you realize bond gains, you're not going to take it to P&L as far as Indian accounting is concerned. And once you do that, you're going to invest back into bonds at a lower coupon.
Okay.
So it's a thing of whether you need to take the P&L this quarter or whether you keep it and take it over the next few years. So it gives you an ability to front end the P&L in terms of booking the profits. But again,
provisioning burden is now, it will maybe you will do it in this quarter.
I think we've been able to do fairly well in spite of not having the bond gains. And whenever we had some of these one-time gains, we tried to use it in terms of setting it aside for future. So let us see. I think clearly from a point of view of bond yields coming down, I think it is positive for banks as far as this quarter and next quarter is concerned.
All right, Srini, we will have to leave it at that. Thank you very much for joining us in our birthday celebrations.
Thank you very much. Thank you.